Azure growth also came in ahead of estimates, up 40% year over year. Joining us now is Brent Thill from Jefferies. Stock's down about 3.5% right now. Brent, why?
Azure was a slight miss. The street wanted a little bit higher on that growth that you just mentioned. And I think that's really largely it. All the other metrics look good. I think the street's not picking up on the booking and the actual RPO. And if you look at those numbers, you're talking about a commercial booking number at 112%, a 50+% growth in RPO. That's one of the best growth rates we've ever seen. And that does not include the new commitment from OpenAI of $250 billion incremental. So OpenAI helped them in the quarter, but all this $250 billion is not in that number as they indicated in the release. So I don't think the market's picking up on that. So that to me is the future indication of health of this company is just blew the doors off on RPO and bookings growth, which is, again, the most important thing that we look at as software analysts. What's the future indication of health? That's it. CapEx was a little bit higher, which everyone had expected. And you saw Google and Meta also raise their guidance. So everyone's asking what's happening to CapEx. We just got basically a raise from all three, from what we can see. And then when you think about margins, everyone's like, well, how can you make money in AI? She put up, Amy, the CFO of Microsoft, put up better margins than expected. So this is further indication that they're making money on AI, that they're not effectively, losing capital on this investment. They're actually driving really good margin improvement.
So the stock's down 3% in overtime right now, and I realize we still have to get through a conference call here too. Do you buy on this dip?
We do. If you look at the booking number, you can't find too many companies growing their backlog. Commercial backlog over 100 and their RPO, which is the remaining performance obligation, over 50. And that's an indication of what's to come for the next several quarters. So we're buyers on Microsoft.
How does this speak to what we saw from Amazon last quarter? They talked about being sort of supply constrained on offering up cloud. It seems like some of the names that were less constrained in how they approached the cloud last quarter continue to accelerate here. What does that mean for the whole hyperscaler environment and what investors are both expecting and hoping for in top line growth and business momentum?
We're year 3 in AI build out, and many are indicating it's a 20-year cycle. We have, as a software analyst, we do a lot of work in talking to the data center experts, and they have line of sight on 5 to 10 years of work. So anyone that thinks this is a 1 or 2 quarter or 5 quarter investment cycle, they need to check in the field. What's going on is this is a multi-year investment cycle. And so we continue to see CapEx numbers going higher. That should result in effectively higher growth for all the hyperscalers. So we think, again, we look at Amazon, to your point, they put up 25% backlog growth. They should accelerate their total revenue growth on AWS as a further indication. So overall, I think we're nitpicking on Microsoft on Azure.
Okay.
1 point, it's not like they missed wide right.
Right. So how important is it? You mentioned Meta. We'll talk about that a bit later. But Microsoft is sort of building software, selling software on its own infrastructure here. When we hear about the degree to which they're getting margin demand for their AI services on top of Office, on top of some of the other things they do, is that important for the valuation and expectations that investors should have about the impact for the bottom line of AI?
Yeah, I mean, as I said, the margins are close to 40%, which is everyone thought margins would go down as Microsoft entered AI 2 years ago. What they've done in the last 2 years is showed you margin improvement. And that's testament to Amy Hood, who, again, is the best CFO in software, hands down. And as long as she's at the helm, she's going to keep driving efficiency. And they're not losing money on this endeavor. They're actually making money, and they just showed you that they can improve margin. So again, I've seen, the last 2 years, and you think about it, in the beginning of a tectonic shift that we're seeing, that you're showing margin improvement, it's because they're able to price for it. They're charging a higher price, and they're able to make money on these services. And as I've said, Microsoft is the best position of any hyperscaler to monetize AI because all the hyperscalers don't live in the application world the degree that Microsoft does. They can monetize in productivity apps, and off-the-shelf ERP, Salesforce automation, custom apps, vibe coding, security, infrastructure. Every CIO is going to Microsoft because they're the one vendor they want to be in a rowboat to a deserted island because they have the entire stack infused with AI. And then from a financial analyst perspective, it's hard to compare when you've got improving margin, good cash flow, and they're doing all the right things. And again, the bogey line maybe just was a little bit higher, so that's why stock's off a couple points. But again, this does not include the OpenAI $250 billion deal. They highlighted that, and that's trapped. So that's what is yet to come. And that RPO will give you a future indication that things are really, really good right now.